Welcome to episode 6, everybody. I can't believe how fast this podcast has been growing. We have listeners in over 20 countries, and we're only picking up steam each and every day. I can't thank all of you guys enough, and I'm truly humbled by the outstanding support. Thank you so much. You guys are truly helping grow the channel and helping it reach new heights each week. Now, let's get back to some investing advice. Remember guys, take time with investing. Don't be too invested in one particular thing. Learn to always be diversified. You will find that those that work in real estate are usually a little too involved in real estate when it comes to their own personal investments. Those in tech tend to be too heavily involved in tech investments. Those in almost any sector are just too heavily involved in their particular sector. And this can even apply to certain companies. So, those that usually end up being fanboys of Microsoft or Apple tend to be a little too heavily invested in those companies. Now, it's not necessarily a bad thing, but learn to diversify. That's where things such as ETFs can really help you, as you can really get broad into a certain area. So, tech ETFs, for example, can help you really get into companies like Apple, Microsoft, and any other ones. Or, if you really want to go really broad, ETFs such as the S&P 500, which tracks the top 500 companies in the US. Now that's one that I use, particularly for my work RRSP. Now I also want to talk a lot about this one particular thing, and I know I bring it up each week, but be smart with your money. You won't be able to work forever. You're going to have to retire someday, either due to old age or being replaced through automation such as machines. Learn to spend less and save more, while also working on ways to earn more. If you take that extra money and invest earlier, you'll be able to retire easier and earlier. Be smart and invest your money for yourself. Now, the first quantitative measure we will talk about is EPS, or earnings per share. This is the amount that the company earns per share. So to calculate this, you simply take the net income or the earnings for a particular quarter or the whole year and divide it by the shares outstanding, which are the total shares of that company available to the public. This figure is usually used for company earnings reports when they issue either their quarterly or annual reports on how the company is doing financially. This can focus on the earnings the company had during a 3-month period or a 1 year period. It is important to look at this to see what the company is making and any anomalies that may occur while digging in to see what may have caused sudden increases in EPS or earnings per share, or any decreases. For instance, a car company could experience decreases with supply line issues, recalls, or just poor sales. This can trigger a lower EPS. Companies could also experience increases in earnings per share as well. For example, the car company could have better sales, perhaps new efficiencies in their supply chain, or growth in a new sector with maybe they started selling some trucks. The overall point is that this indicator can help show what each share is earning. And looking at historical data for this can show any anomalies. So they can show how the EPS has grown over time or perhaps has suddenly started to decrease. It can pretty much give you a overview of what that share earns and over time how it is performed. Now the next financial ratio we're going to talk about is called the PE ratio. Now if you ever Google any company, you will notice that their stock will say a few different things. You will see the ticker symbol, which is the unique identifier for the stock on the stock exchange. You will see the current price that the stock is trading at. You will see the market cap. You will see the historical price over a time period such as 1 day, 5 days, a month, a year, whatever. And you will also see something called a PE ratio, along with a few more things. Now, the PE ratio is the price to earnings ratio. What this means is that you take the current price that the stock is trading at, and you divide it by the earnings per share. This will let you know how much you are paying for that share based off of what it generates. So it'll show you how much you're paying per share in comparison to the net income that share generates. There are actually two types of PE ratios now. One is a trailing 12 months, which looks over the last 12 months. And this will pretty much let you know the price you're paying per share in comparison to the earnings that it's had over the last 12 months. An example of this is, imagine you've bought a share of a company called ABC. Now, this is just a fictitious company. The price is $10 a share for ABC, and the company reported a 50-cent EPS for their last 4 earnings reports. Now, they've recorded 50 cents for each one of these earnings reports. Now, when you add up all of that, you get $2 for the last 12 months. This will mean that you take the $10 per share and you divide it by $2, which it is earned per share over those 12 months, and you will get a PE ratio of 5, so a price to earnings ratio of 5. Now, the second type of PE ratio is called the forward-looking PE ratio, or the PE growth ratio, which some call it, which tries to predict what the future price to earnings ratio is based off of future earnings per share estimates. For example, if a company that had a total year's earnings growth of $1 2 years ago and $2 1 year ago, the future earnings per share could look like $3. Now, if you take the share price that company is trading at, which is $10, then we have a forward PE ratio of 10 divided by 3, which is 3.333 continuously. This means that based off of future estimates, you are just paying 3.33 times the estimated future earning power of that share. Now, you may be wondering why the PE ratio is important to take into account when investing in a company. Well, you should see why a company may have such a high price to earnings ratio. This may be due to an innovation or a product that is yet to hit all of its target audience. Or perhaps the company is still working on something and is yet to bring it to market, but can be a real big game changer and revenue generator once it does hit the market. Now, perhaps it's the opposite and the PE ratio is very low, meaning you're paying close to what the company generates in a year per share. This can be either a really great find, or it could be a company that doesn't have a great future outlook because it's not attracting a lot of investors. So for example, with a really low PE ratio, investors are fearful because they see either this company not being able to maintain this in the future, as you can see with oil companies right now, where yes, they may be able to turn a good profit, but how long can they really be doing that for? So it is a great indicator, and it just sometimes it'll make you wonder, hey, why is this trading so high compared to its earnings, or why is it trading so low? And it'll get you digging a little further into why that may be. The next thing we're going to talk about is the price to book value. The price to book value is the total worth, the book value is the total worth of the company by taking into account its assets and liabilities. For example, your personal book value could be all the things that you own and have monetary value versus all the money or debt you may owe. So let's say you have $1,000 in cash. Your possessions are worth about $2,000 if you sold them today, and you owe about $500. So that means you have about $3,000 in assets and $500 in debt. That would mean you have a personal book value of $2,500. Now, the price, again, is the price per share that the stock is trading at, which you divide by that book value, where you take the assets and you minus the liabilities per share. So this would mean that you would take the entire assets of a company minus the entire liabilities of that company, and then divide it by the total amount of shares that might be out there. Now, this ultimately lets you know that if the company had dissolved today, what would your share actually be worth? This means that if the company no longer made any more money and they decided to just close up shop today and they sold all their assets and used the money to pay off any debts, what is your return? What are you left with? This is a terrific way to understand what the real-time worth is of the assets to liabilities that company owes. So take, for example, any REIT companies that own real estate. It's a lot easier to gauge that if the company were to dissolve and sell everything, what you would be left with per share. The next ratio we're going to talk about is the debt to equity ratio. This is quite a simple one when we take into consideration what we've already covered in this episode. The debt to equity ratio is used to look at a company's financial leverage. It will take all the debts that the company has and add it all up. It will then compare it to the total stockholders' equity in the company. The stockholders' equity is simply all the stocks which have been purchased by people, and including preferred stocks and any paid in capital into the business. So to make this quite simple, let's put it in terms of an individual person that owns a home. So this person has a mortgage and a line of credit that is $50,000 and $50,000 respectively, which is a total of $100,000. He has also put in $500,000 into this house. So the individual has a debt to equity ratio of 0.2 when you take that $100,000 of debt and you divide it by his $500,000 that he put into the house. Now, in an investment perspective, this might seem like a good investment, but it is only good from the bank's point of view, as they know that their money is protected. What they put into the house is covered. From the individual's point of view, though, I think he can leverage more money and get that ratio up to use his house to perhaps acquire another property or do some other form of investment with that money. So instead of having all of his money trapped there, he can leverage some of that debt on it, get that debt up, and try to acquire or invest that money into something else. Now, the final indicator that we're going to talk about in this episode is EBITDA, or EBITDA, which stands for earnings before interest, taxes, depreciation, and amortization. So what this means is that you take the net income or earnings, in other words, you add any interest they're paying on any loans or any kind of debts they may have. You take any taxes that they paid on their earnings, or the company's paid in general, any depreciation for the assets, and any amortization expenses, and you add it all up. Now, EBITDA is effectively the profitability of the company before all the expenses they may have. It essentially gives you a snapshot of the true potential of the business. Let's say if a company was leveraged pretty heavily, but it's slowly paying off those debts. During that leverage period, where they might be reporting either near zero or negative earnings per shares, you can actually see if the company does truly have a profitable future. Take, for example, a company which is ABC, which has a net income of $100,000. Then you add the interest, which is about $15,000. You add the taxes, which is another $15,000. You add the depreciation, which is $30,000, and you add amortization, which is $40,000. Now, adding that all up together, you get $200,000 for that year. But when you look at the earnings per share, the company has a zero earnings per share. So essentially, the company has a good product or service, and the year before EBITDA was only $100,000. You will see that the company technically has grown their EBITDA, even though their earnings per share is still zero or negative maybe. You will see in fairly newer companies that this is quite normal. as you usually have those more running up costs in the starting just to get that business going. But it can also help you spot when a company can have a great potential future if they get those expenses down. Where if they do have a great product, it will eventually go down. Now, a great example of this would be Apple in the early stages. When it was just in a garage, and even then when they moved out of that garage and they started getting the business going, their EBITDA was there, it was growing, but the earnings per share was still negative. Now, this is just due to the startup costs that they had, the cost of growth, the cost of marketing their products, the taxes that they're paying. All those costs, they do add up. But eventually, they can start taking the EBITDA, growing it up, turn down those expenses, and you can truly see that reflected in the earnings per share. Now, I know this last one was a little more difficult to follow, but it'll make sense. If you want to learn these calculations, it's quite simple. Pick any random company. Look at the the equation that we've talked about. Plug in the numbers, and you will get the EBITDA. You will get the book value. You will get the price to book value. You will get the price to earnings. You will get the earnings per share. You'll be able to figure out all of these different ratios.
Hey guys, this podcast was brought to you by our sponsor Anchor. If you haven't heard about Anchor, it's the easiest way to make a podcast. Now let me explain. It's totally free to use. There are creation tools that allow you to record and edit your podcast right from your phone or computer. Anchor will also distribute your podcast for you, so it can be heard on Spotify, Apple Podcasts, and many more. You can also make money from your podcast with no minimum listenership. It's everything you need to make a podcast in one convenient place. Thank you.
Now, these are just some of the ratios out there. There are so many that you can look into and should look into. In fact, an indicator I like to look at is year-over-year revenue growth or price to sales. If picking individual stocks does interest you, I highly suggest looking into indicators and ratios more. Also remember that not one single ratio can tell you all about a company. You need to use a combination of these and also still understand the qualitative data on businesses that interest you. Another point to note is that these don't just have to apply to stocks. They apply to real estate, starting your own business, and pretty much understanding the profitability and financial aspect of many investment opportunities. So I really hope this helped you guys out. And if you do start researching further into these types of ratios, you're going to find that you'll be learning a lot more about the quantitative factors when it comes to investing. And it's really going to help you guys kick off your own investing journey and starting off your portfolio, whether it be index funds, real estate, individual picks, or anything for matter. Well, that's all for this episode, folks. Make sure to subscribe to the YouTube channel. I will be doing a few fun tutorials very soon on how to crowdfund, how to build your own portfolio, and also potentially something big and exciting that I'm going to keep a little quiet on. So don't miss out. Go follow the Average Investors podcast on YouTube. Make sure to subscribe. And also make sure to send any questions or topics you may have to theaverageinvestors@outlook.com. It's also linked in the description. Thanks for listening, everybody, and take care.